Swayam Prabha. Digital India. Educated India.
I've defined money supply. So it's not very simple. It's quite complex. Many things are there. Depends upon the definition you're using. M1, M2, M3, M4, traditional monetary aggregates. Then I talked about the new monetary aggregates. Late 90s it came. 3, and M1 and M2 and M3. Even they conceptualize liquidity aggregates, which is a combination of monetary aggregates and something else. I did not go into the details because it's not very clear the items involved there to me. Then what I did was, I was trying to go into the money supply more in the context of macroeconomics. And I took up the concept of velocity of money, which is equally relevant to the entire money supply in a country. One is the monetary aggregates, but the money supply consists of just not monetary aggregates. Money supply consists of also the velocity of circulation of money. Now, that velocity of circulation of money along with monetary aggregates amount create the total effective supply of money in the country. Remember, so एक रुपया आपके पास है, उसके पास कितना रुपये काउंट करके होगा नहीं. This रुपया, how much is it traveling on an average per annum is very important. Because why money is required, the basic thing is money is required to transact goods, medium of exchange. But then money is also used for other functions, where the velocity somewhat gets reduced. Because transaction of goods increases the velocity of money. I bought something from you, you took that cash, bought something from him. He went in the evening and bought something from somebody else. But if money gets stored and not being out in circulation, then the velocity reduces. It may still have a velocity. Bank invests somewhere, bank gives out a loan, etc. There are various leakages. The question is, who invented velocity? Well, the velocity, one of the earliest discussions can be found in Irving Fisher's book. He wasn't looking for something called velocity. He was simply looking for the connection between money, stock, which is monetary aggregate, central bank में कितना print किया और छोड़े है economy में. I will tell you how they छोड़ते हैं later. How much they printed, the stock of money, and the total value of goods and services, because what he found, the total value of goods and services is much more than the stock of money. So, to establish the connection, the V variable came into existence. So, it became MV into PY, which is also the quantity theory of money, because he belonged to the classical macroeconomic school. The quantity theory of money was the cornerstone of the classical macroeconomists, where it simply said at any point of time output is given, velocity is also determined, given. So, prices are proportional to money supply, money stock basically, M and P are proportional relationships. That is the quantity theory of money. Now, in this thing which is called quantity theory of money today, MV is equal to PY, he called that equation of exchange. Quantity theory of money, I think, was termed in England. So, let me tell you more about it. Around that time, when Fisher's equation was developing or being developed, early 20th century in US, and he came up with mv is equal to py, where v is found greater than 1, he said, okay, this is, I don't know whether he called it, this is velocity of money, but this is not a constant for years. Velocity of money is also a variable, maybe a slow variable, changes slowly. And what did he say? He said it is determined by institutional and technological development of a country. So it depends upon the banking system, institutions, the central bank regulations, the central bank habits of printing money, central bank policy about how much M will be, institutional factors, and technological development. How good are the bankings? Today we have ATM tellers, automatic teller machines, ATM outlets. We have electronic money also. These are all technological developments. They developed through the discovery or invention of internet. Prior to that, when I was a student, when there was no internet, automatic teller machines were there only, but no e-money. E-money didn't exist. So various kinds of money developing. So all institutional and technological developments determine what the value of V is going to be. That's Irving Fisher. You may not like it. You may not agree with it. But the point is, this is what he was trying to say. And he was saying also, particularly coming from US, where cards have become popular for a long time now. It's not like India. So he was saying that if the economy uses more credit cards and various forms of electronic money, which I can say now, lesser amount of cash will be required to buy things. You don't need the cash. Cash may stay in the bank. It's not coming out. I give the card. The seller gives me a receipt, all right, then takes the bill to the bank where I have an account, and he may also have an account there, and the bank simply debits and credits two accounts, takes money out from my account, puts it in his account. No cash use, all internal. So you can see velocity will come down. So with technological improvements, in some sense, like cash and tech and institutional features, V may come down. On the other hand, I can see that V can go up because we have automatic teller machines. So रात में 10 बजे है, हमको भूख लग गया, रुपया नहीं है, कोई बात नहीं है, हॉल 2 के सामने या हॉल 1 के सामने चले जाओ, इंस्टेंट टेलर मशीन है, कार्ड डालो, कैश निकालो, कैंटीन में चलो. Now this, without that machine, would stop that use of cash. So it can also increase it, velocity of money, automatic teller machines. So it becomes or it remains an empirical question as to what will happen. Now another thing is that with the checking system, use of cash has gone down. You won't believe me, in India we use a lot of cash to pay the bills. Abroad, they do not use cards even. The bills at the end of the month arrive in an envelope containing another envelope inside it with the address at your doorstep, in your mailbox. You simply write a check and seal that envelope which is already there and post it. Even cards are not required to make the payments. So all monthly payments can be made simply with checks. Telephone bill se shuru karke, cable TV, everything. Of course, bank loans and stuff you can make payments. Sometimes they are automatically deducted from your account. You give a permission, bank automatically deducts it. You don't have to go to the bank to make the payment. Bank, if you give the instruction, automatically at the end of the month some amount EMI will be deducted. Acha. So with this complexity, velocity of money can become quite an issue, all right? And why is it important? Because that determines the effectiveness of money supply. Okay, next. Around that same time, okay, now you can see this equation of exchange. If I play around like a theoretical economist, I can play a game like this. which is important, which is exactly what was happening in England. In England, what was happening, they were not talking about equation of exchange and the relationship between total value of goods and services bought and sold in a year and the total stock of money. In England, what they were doing is something quite different, and what the thing they were doing is something what interested them. And I have met economists or students who studied there, and they were a lot interested. I don't think these days, but they may still be. This is something, their interest, particularly in Cambridge, from where Keynes, John Maynard Keynes came and wrote the book. The Cambridge economists were particularly interested in something called demand for money, and they were looking into variables that will affect the demand for money by the individuals of a country. What motivates people to demand money? What are the variables which influence the quantum of demand for money? So, they were more into demand for money, which you have seen in macroeconomics. The LM curve has supply of money on one side and demand for money on the other side, and famous Cambridge economist Keynes's contribution was the speculative demand for money, which did not exist in the classical macroeconomics. All right. So, the demand for money, you just turn around this equation and you will see the research going on and the work going on in England is so similar to what was going on in US, although two different discussions were going on. If I write Fisher's equation as MV is equal to PY, MV is equal to Py, and I turn it around as M is equal to 1 over V Py and call that K Py, where K lies between 0 and 1 because V is greater than 1. So, K is between 0 and 1. Then this equation M in Cambridge was written like this: demand for money is equal to K Py, where demand for money is some proportion of the nominal income in the country. Completely different interpretation. How much money do people demand? It's a proportion, a fraction, as a matter of fact, K is less than 1, of the total nominal income of the country. How much income I have will determine how much money I demand to buy goods and services. So, Fisher's equation, like a clever person, I turned it around and it becomes a demand for money function. Then people say, what macroeconomists do, this demand for money, assuming an equilibrium condition, is also equal to M, the supply of money. So, supply equal to demand for money, I can measure that, is nothing but a K of Py, a fraction of the total nominal income. Now, you see that the velocity concept in Irving Fisher, that money travels more time, can be turned around into a simple behavioral equation like people, how much money would they use? Demand for money means how much money are they using or demanding to buy goods. It depends upon their nominal income. At the macro level, that's true too. एक ही इक्वेशन दूसरा करके लिखेंगे, एक completely different interpretation is coming out, and this was the line of thinking in Cambridge, but they were not thinking together, and two are very well connected. That I demand money, a fraction of my total income, is the same thing as the total effective supply of money is equal to the total nominal income. And the money required to buy those nominal goods and services, total amount of goods and services in nominal terms, requires much lesser stock because there is something called velocity of money. More or less the same thing. Now, I come to the demand for money. What are these Cambridge economists are saying about demand for money? First of all, you have seen that it is a proportional, it has a proportional relationship with nominal income. What is nominal income? Income in money terms, P into Y. And what is Y? Real income. What is real income in macroeconomics? All goods and services produced is real income. Remember, Y is the physical volume of apples and oranges and chairs and cars and buildings produced. What is the nominal income? The total value of those items in market prices. Because when you're producing, you're generating income at the same time. You're making payments. If some payments are not made to costs, the payments are made to yourself as income, profit. So the total value of goods is also total nominal income in the country. Same thing, depends which way you look at it. A coin has a head side and a tail side. Look it from the head side is one interpretation. Look it from the tail side is another interpretation. It's the same thing, it's the same coin. Nothing changes. Achha. Now, two Cambridge economists were particularly involved with this demand for money research and thinking, and they were the teachers of Keynes, Alfred Marshall and A.C. Pigou. Marshall was definitely, Pigou probably was also a teacher. They were prolific writers. They wrote, Marshall's book is in the library, very interesting. Alfred Marshall's book, I don't know who bought them, probably 40 years back somebody bought them. It's no longer available in the market. It's in our library, I've seen it. It's called Principles. You can check that out if you want. These are the godfathers of economics profession. Alfred Marshall's book is there in the library, I've seen it. Acha. So Alfred Marshall and A.C. Pigou came up with an equation like this, which they call demand for money. And